What's going on, money lovers? Welcome back. Today I want to do something a little bit different in light of a book I just started reading that I got for my birthday, written by one of my favorite members of the Shark Tank panel, Kevin O'Leary himself. Here's the book. It is called The Cold Hard Truth on Men, Women, and Money. So looking forward to getting through this. Should be interesting. So that inspired me to take an in-depth dive into Kevin O'Leary's investment portfolio and also his investment philosophy. I took some notes here. I'll just rattle off what Kevin O'Leary's investment mantra is to start off, and then we'll look at his ETFs that he started. So in an interview with Mr. Wonderful himself, he stated that over the last 40 years, this is within the last couple of years I believe this interview is from, that over 70% of market returns have come in the form of dividends, not in capital appreciation. So mainly for this reason, O'Leary is primarily a dividend guy. He said that he would never buy a stock that does not pay a dividend. I did find a clip of him saying he owns Tesla stock though, because it's almost profitable. This is, going back a couple years probably as well. They don't pay a dividend, obviously. So he does break his own rules a couple times, we'll see. But overall, only invest in companies that pay dividends, which I think is very interesting, and it makes a lot of sense. And his whole argument is you can't refute this data. Dividends are great because they give you consistent, reliable, steady cash flow, and that is his ultimate goal. And that is Kevin O'Leary's ultimate goal, preservation of wealth. So he's got 3 rules that he follows in his investment portfolios. And I'm smiling because I caught him break it a couple times, but we'll get to that. So number 1, he never owns more than 5% of any one company. So no company makes up more than 5% total holding in any portfolio. Number 2, he never owns more than 20% into one specific sector of the S&P 500. So what does it mean by that? He's not going to allocate more than 20% to technology or healthcare. He's going to keep it as even a split as possible, or at least under 20% to each sector. And number 3, third rule, he hates volatility. So he tried to build portfolios that have less volatility. And a good way to do this, large caps tend to have low volatility, but even more so than large cap companies, which means companies that have high market cap. Think of big tech companies like that. And what do I mean by large cap company? That means that a company has a market capitalization of over $10 billion is the traditional metric. But when you think large cap company, just think the top dogs of the S&P, big tech, Apple, Microsoft, companies like that. Those are large cap companies. So many of his fund holdings are large cap companies, but even more so to mitigate volatility, that's where the dividend stocks come in. So dividend paying stocks historically have tended to be less volatile. Now, it doesn't mean crazy dividend stocks that pay, 10, 15% dividend yields. Those are dividend yield traps, which the dividend is probably going to get cut sooner or later. He means stable dividend-paying companies have been around a long time. Think your Johnson & Johnson or even Apple that have a long history of paying out a dividend, steady cash flow, an increase in cash flow, and increasing their dividend. So over time, the idea is you'd put more money into this. When the market corrects, hopefully you would have to deal with less of the downside, so less headache for you. And over time, your dividend yield should only continue to increase, and so should the growth, but he's more so focused on dividends. So again, preservation was his major focus here. And when he's looking at what companies to add, he and his team, they look for cash flow. They look for increasing cash flow. So year over year, companies that are making more profit, more revenue, cost of revenue is going down. However they're doing it, they're ending up with more cash in hand after all is said and done with eeach passing year. And because when they have increasing cash flow, that's how they're able to fund ever increasing dividends. So you'll see companies with a dividend, compound annual growth rate of maybe 5%. So each year they strive to increase the dividend 5%. Some companies may increase as much as 10 or 20% or even more. But the only way you can do that is if your cash flows are continuously increasing. So thus, this is how his O'Shares ETFs were born. These ETFs hold time-tested companies that have great cash flows and are capable of paying dividends. And thus far, they have performed very well. So we're going to look at the holdings, how they perform. So let's get to his funds. Alrighty, so here we go. Directly from the O'Shares ETF website. We'll start off with OUSA, the O'Shares US Quality Dividend ETF. So why should you invest in it? It has a strong 5-year dividend growth rate of 10%. They seek companies with strong profitability, balance sheets, and dividend growth, which may reduce risk of dividend yield traps. I touched on that earlier, while providing a growing source of income. So as you can see here, its inception date, it's been around since 2015, so not too long of a track record. I typically like to invest in ETFs that have been around a little bit longer, but it has done well so far. It's trading at around $44 right now, and it pays a dividend yield of surprisingly only 1.63%, but that's because he's not going for yield traps. He is going for companies that are growing their dividends. So in order to have a lot of room to grow your dividend, companies tend to have a low dividend. And the hope is a few years from now, maybe this dividend yield is up to 3% or 5%. So as you can see here, the fund's performance year to date for a little over 14%, 1 year 26%, and 5 years almost 12%, and since its inception a little over 12%. So if we were just to quickly compare the last 5 years of OUSA, it is up about 61% compared to SPY, the S&P 500 index, which is up 100%, 104%. So almost double Mr. O'Leary, Mr. Wonderful's fund here. So it is underperforming the market. And if we take a look at their top 10 holdings, you've got all dividend paying companies, obviously, Microsoft, Home Depot, Johnson & Johnson, Procter & Gamble, Pfizer, Cisco, Merck, Verizon, Apple, and Eli Lilly & Co. So some great names there. And as you can see, he did break his rule here. That's probably because Microsoft has been on such a tear. Microsoft is 6% of the fund's weighting. He said he never goes over 5%, but we'll give him a break here. It's just, sometimes companies do great. What can you do? I'm not going to sell Microsoft just because it's going up. So as you can see, these are all companies that I think are great, stable dividend payers. And you probably do get more stability, as you can see with OUSA. If we look at the COVID drop, for example, it went from 36 to let's say 25. It lost about 30% of its value, versus SPY lost about 33%. So not faring much better than the S&P during the COVID crash. But then again, who could have seen the COVID crash coming? I mean, that was unlike anything that has ever happened, probably since the Spanish flu. Let's look at some other metrics here. So we went over the top holdings. Now they differ a little bit here, but this probably is not as updated as the other sheet. If we go down here, you can see how this fund is weighted by sector. So technology making up 23%, healthcare 22%. He broke his rule again, going over 20% allocation to a given sector, but again, nothing you can do. Technology and healthcare have been on an absolute tear, far outperforming the other sectors, so that's going to happen. But you are pretty well diversified here. And one last thing to note here, it does have an expense ratio of almost 0.5%, versus SPY, I believe, is 0.1. So SPY's expense ratio is only 0.09, so let's just call it 0.1%. Comes out over the long term to significantly less. And there's even lower funds. If you look at Vanguard, they do the same thing with VU, and you're probably only paying maybe 0.03, 0.04. But so overall rating on OUSA, it does look like you are better off in the last 5 years just being in a regular index fund, and that will probably be the case over the long term as well. OUSA, higher expense ratio, lower performance, not really doing much better than the S&P during the COVID crash, which is when I would hope that being in these types of funds would really benefit you, that they wouldn't go down as much. All right, moving on to OGIG, or OGIG. I think this is my favorite of the bunch here. So this is the Global Internet Giants ETF, and its 2020 performance was 107%. So real quick, let's just compare this one to the S&P here. So this fund has only been around since 2018, even shorter runway here. But from 2018 through the present, it is up 120%. If we compare that to SPY, starting at June in 2018 as well, SPY is up 84%. So OGIG has outperformed SPY in the 2 years it's been around. So not really long enough to justify choosing it over SPY, let's say, but could be onto something good here. So what exactly is OGIG? Focused on growth of new tech driven by megatrends of e-commerce and digital innovation. Access the internet giants of today and the potential giants of tomorrow. I like the sound of that. So same expense ratio, 0.48. Now this one, interestingly enough, does not seem to pay a dividend. You can see its performance, 1 year, 33%. Since inception, 28%. So those are good numbers. But again, can't really see much from just 2 years. I would like to see more like 5, 10 years or more, ideally. And if we look at its top 10 holdings, you've got Alphabet or Google, Amazon, Microsoft, Tencent, Facebook, Alibaba, Mercado Libre, I can't even pronounce the next couple, in Shopify. I do like some of the names I see here, and if I were to pick from OUSA, I would and OGIG, I would definitely go with this one. Can't go wrong with these big tech companies. You also get, some great exposure to some great Chinese companies here with Tencent and Alibaba. So I like what I see with this fund. And this one is far less diversified, obviously, with the primary focus on technology, 40%, communication, 31%, consumer discretionary, 28%. So it's interesting. This OGIG fund kind of goes against all of the principles of O'Leary that we outlined in the beginning of the video, but you know what? You change with the times, and that's fine. And you're pretty well diversified here. 63% exposure to the US, 18% China, and then a few percentage points allocated to many other countries, so that's great too. So far, I like OGIG better than OUSA if I had to pick one. Let's go to the next fund here, OUSM. So OUSM here, interestingly, is a small cap quality dividend ETF. So we're getting away from the large caps, meaning probably not going to know many of the companies in here. So it seeks small cap companies with strong profitability, balance sheets, and dividend growth, and a potentially lower risk way to invest in small caps. So I like that approach. I mean, that probably, when it comes to small caps, is the best thing you can do. Unless you really research a small cap company and, get lucky, a combination of the two is really what it takes. I think people tend to lose more money with small cap than make. So this could be a good way to play small caps and get you some diversity in that regard. That's something to think about because, I know personally, and I'm sure a lot of you as well, I'm primarily in large cap. I mean, the S&P is mainly large cap, and my top holdings are definitely large cap. So I really don't have much exposure to small cap. So this could be a potential buy too here. Let's see. So same expense ratio, 0.48. Dividend yield, 1.57%. We see its performance here, 1 year, 38%. Since inception, 11%. And if we compare it to S&P again. So OUSM also not been around very long, since 2016. So from 2016 to now, it's up 43%. Compare that with SPY since 2016 is up more than double, almost triple that of 110%. So this is definitely not something I would invest in if I were looking for growth, but this is probably something I would look into if I did just want to diversify and add some stability to my portfolio, add some extra diversity. But as you can see here, the small caps tend to get hit pretty hard as well during crashes. I mean, it was down even more than the S&P, down 38%, but can be a good way to diversify. And if we look at its holdings, you can see here on the screen, I have not heard of any of these. Let me know if you have in the comments below. And also, guys, let me know what your take is in the comments below. Are you a fan of any of these funds? Why or why not? If you're enjoying the video so far, please don't forget to like and subscribe. So yeah, I don't know any of these companies. They're all small cap. That's not my forte. Well diversified here, industrials, financials, 23% and 20% respectively. And last but not least, OEUR, O'Shares Europe Quality Dividend ETF, invests in global leaders in Europe with strong profitability, balance sheets, and dividend growth. Same expense ratio of all the funds, 0.48%. Dividend yield is a little bit higher, 1.78%. Performance, not so great since inception, almost only 6%, so that's far underperforming the market. And this fund's been around a little bit longer, since 2015, so it's underperformed the market, but this is another great way to diversify, especially if you're bullish on European companies, or you just want some exposure there without having to pick individually. This could be the fund for you. Top holdings here all make up under 5%. So we've got Roche, Novo Nordisk, Nestle, Unilever, and some others. So if Europe's your cup of tea, this could be the fund for you. Sector allocation, roughly this. So this one, interestingly enough, more industrial exposure, 25% almost. Consumer staples, 24%. Healthcare, 20%. Technology is only 8%. Because the US of A is home to big tech. So that's interesting. It's also another you could think about as a good way to diversify in that regard. I know I am heavily overweight in technology just because of how much everything's run up. And I've been trying to do a better job, allocating money to these other sectors, specifically healthcare. Financials is a toughie, to try and diversify into financials, because I think so much of the future of financials has to do with fintech and companies like SoFi. Is that a financial or is it technology? It doesn't really fit into one basket fully. It's kind of a lot of overlap. But anyway, this could be a good way to diversify out of technology as well. And you get some great diversity throughout many of these European countries. You can see here, interestingly enough, Switzerland is the biggest, coming in at 23%, then the UK, 20%, followed by France and Germany. Those are all of Mr. Wonderful's funds. So, what do you guys think of the funds? Let me know in the comments below. Did you enjoy this video? If you did, please don't forget to like and subscribe. Hit that notification bell so you know when I post in the future. Let me know what your thoughts are in the comments. I read all the comments, always looking for new ideas to make videos on. This is Vinny from the Investment Club, and I'll see you next time.